Welcome to Stock Informer for you. The noise in the market is loud, but we prefer to let the data do the talking. DMart, Avenue Supermarts. For nearly a decade, it has been the poster child of Indian retail, a flawless, low-cost execution machine that turned retail logistics into an art form. Investors treat it like a safe haven, routinely awarding it premium trading multiples that leave global peers in the dust. But what happens when you push this retail engine to its absolute operational breaking point? Today, we are taking an institutional look at DMart's freshly minted Q1 FY27 financial results. But we aren't just reading the headline numbers, we are subjecting this giant to a brutal 10-part operational and neuro-economic stress test to find out its true intrinsic value. If you want to know what a worst-case macro disaster looks like for this stock, let's run the numbers. The baseline, Dissecting, Q1 FY27. First, let's lay down our baseline. Looking at the latest consolidated Q1 FY27 numbers, DMart pulled in a massive 18,794.53 crore rupees in revenue from operations. That's a rock-solid 14.88% year-on-year volume and value expansion compared to the same quarter last year. When we drill down into the cost structure, the cost of goods sold came out to 15,825.83 crores rupees, leaving them with a tight but efficient gross profit margin of 15.80%. Now remember, DMart operates on an everyday low price model, which means their advertising and promotion expense is essentially zero. They don't need fancy ads. They let the discounts do the talking. Moving further down the P&L, after accounting for 1,017 crores in other expenses like logistics and power, core EBITDA lands at 1,499.34 crores rupees, giving us a healthy operational margin of 7.98%. Profit after tax clocks in at 860.44 crores rupees, and the operational cash machinery looks flawless, turning over its inventory roughly every 34 days. At a share price floating around 4,081 rupees, this puts the market value at a staggering premium. But this pristine baseline assumes one thing: a perfect economic environment. The 10-factor shock reality. Now let's break the model. What happens if the global supply chain fractures or if consumer behavior shifts overnight in 2026? We threw 10 severe but plausible shocks directly at DMart's operational baseline. First, we injected an input cost commodity shock, a 15% spike in raw materials and crude-linked packaging with zero price pass-through. Boom, 2,373 crore rupees wiped out instantly. Next, we modeled the stagflationary volume trap, an 8% drop in sales as consumers trade down to private labels, along with a quick commerce margin squeeze. In 2026, convenience is king. If DMart is forced to slash realizations by 3% just to compete with ultra-fast Q-commerce apps, it strips another 563 crore rupees off the top line. Add to that a 25% surge in logistics freight costs, modern trade discounting pressure, regulatory green compliance taxes, and a 20% crash in rural demand due to monsoon failure. And the cumulative damage is staggering. In this multi-factor worst-case scenario, the celebrated gross margin compresses from 15.8% down to 11.2%. Operating margins collapse to a razor-thin 1.85% because of massive operational deleverage. The cash cycle blows out from 26 days to over 42 days as capital gets choked up in inventory, and that pristine 860 crore rupees quarterly profit flips into a 412 crore rupees operational loss. This reveals DMart's biggest hidden vulnerability. Its thin operational margins leave it highly exposed to prolonged cost shocks. Valuation discovery and the final verdict. So, what is the stock actually worth? To find out, we have to look through two completely equal lenses: the current priced for perfection financial reality and our stress-tested valuation. Under a normal progression, if DMart maintains its steady trajectory, a justified forward P/E multiple of 85 times on an EPS of 58 rupees yields a fair value of 4,930 rupees per share. Our standard DCF models support this, pinning the intrinsic value right around 4,650 rupees. But now, let's apply the stress lens. If the neuro-economic landscape of 2026 takes over, where extreme brand infidelity and high resourcefulness cause a structural volume drop, growth visibility falls off a cliff. De-rating the stock's forward PE multiple to a more conservative 60 times on compressed earnings drops the target price to 1,896 rupees. When we rerun our DCF with an elevated cost of capital climbing to 12.5% to account for this massive margin volatility, the stress-tested floor lands at 2,480 rupees. This gives us an institutional target price range of 2,650 rupees to 4,800 rupees. Here is the bottom line. DMart is a world-class operator, but its current stock price leaves absolutely no room for error. If these macro shocks crystallize, the fundamental downside risk stands at a maximum of 35.06%, down to the 2,650 rupees support level. If you're holding DMart, you're betting on a perfect macro environment. But in a volatile world, defensive capital management is key. What do you think? Is DMart an unshakable retail king, or is the stock priced too high for comfort? Let me know your thoughts in the comments below. Don't forget to like, subscribe, and hit that notification bell for deep dive institutional breakdowns. I'll see you in the next video.